of the U.S. stock market in particular, which is the most vulnerable of all the markets. Why? Because it's the biggest bubble. You look at the European markets, certainly not China. China's not even double its price in 2009. We're eightfold higher than we were in 2009 in the S&P, and about 17-fold higher than we were in 2009 for the NASDAQ 100. And the bull markets have been much older. You were talking 15 years now. Prior bull markets like 1923 to 29, or the bull markets peaked in the 1970s in the S&P like in the mid-70s, or the 2000 .com, 2007 peak. Those followed only after about 3 or 4 years of doubling or tripling in price. This one is far bigger. Now you can say, well, the economy must be better. No, look at an M2 chart and you'll understand, but especially look at Fed funds. I mean, there's never in history that we've had like 10 of the last 15 years where zero was the cost of money. So, if money's free, in effect, the pricing of money, the interest rate, people make decisions based on that. They commit money. They buy stocks. Companies expand their facilities. Governments spend more money, etc. Based on what? One of the bricks in their building structure is the cost of money. And if they've been deluded to think that the cost of money is free or going to stay so near free forever, then a lot of errors are committed over that period of years. And when the error is exposed, it's like ripping a bandage, taking a needle out of your arm that's been giving you hallucinogenic drugs for the last 15 years. And suddenly reality hits, regardless of what the Fed does.
On this episode of the What the Finance podcast, I have the pleasure of welcoming back Michael Oliver. He probably doesn't need an introduction. I think he's definitely been on the podcast quite a few times. But for anyone who doesn't know him, he's the founder of Momentum Structural Analysis. So, Michael, thanks so much for coming on the podcast.
Great to be back, Anthony.
Yeah, looking forward to it. And we're just talking before, a lot happening in the world, so I'm sure we'll touch on a lot of it in the coming hour or so. But last time we spoke, it was in about May, and at the time you thought things would get quite bad and for the rest of 2024, especially for markets. But I feel like we've had a lot of volatility, but at the same time, stocks seem to go up. Oil hasn't really moved at all. It's gone up and down, but it's at the same level. Are you still seeing this potential hell in the markets, or do you think maybe it's been overcome?
Yeah. Stock market must be very frustrating for bears right now because they can't quite understand why does it stay up here. And if you go back to July on like the S&P 500, you're above there, but marginally. You go back to NASDAQ 100's high in July, you're slightly below there. So it's really to July, August, Sep, okay, it's been 4 months, really non-event, except it won't go down. The issue is, well, what's the major move left here? Is it still more upside or is it going to break? I think it's going to break down. And the reason I say that is when we run our momentum studies, we look at price secondarily, okay? Our momentum studies of price, there's trend structures below the market where if you looked at the momentum chart, you would say, my gosh, there's a floor there. You better not break. You cannot see it on a price chart. Price chart is this upward, arcing thing. But on momentum, you have this repeated use of similar levels on the momentum chart. So it builds a floor. Well, if you go through the floor, you're breaking down. And it's so close and nearby in terms of what numbers does it take to break these things that a bad sneeze would do it. Okay. And I think it's going to break. When you build a momentum structure that's bleeding obvious, not on price, but on momentum, where you see vulnerability if something is broken, you use it. It's built for a purpose. And I'm going to try not to bang the table on this too much, but before I founded MSA in 1992, in 1987, I caught the crash. I was a futures broker then. No, I didn't catch it in a great big way, but I did catch it. And for me back then, I made some decent money. Okay. It had a momentum structure on the S&P 500 that's identical to what the NASDAQ 100 has right now. The only difference is NASDAQ hasn't broken the structure yet, but it wouldn't take a couple % drop to start to trigger it. Okay. So we're watching the stock market very closely because it's one asset category that I think is going to get shaken up. And when it does, that's when all these so-called economic data points that the Fed likes to point to will go sour, go south fast. That's always the way it happens. It's never the case where you make a bull market peak and the data points suddenly go horrible and then the market goes down. It's the other way around. Market goes first, then the data points follow. And of course, we know what the Fed will do, and the EU and the BOJ, and et cetera, et cetera. They'll print. All the policy tools they can use, they'll use. And even Powell has said he's on the other mandate now. That is, the job market is more important. The economy itself is more important than the, quote, inflation numbers. So that's what I think gold has known all along. Namely, the central banks are not going to quit doing what they always do. And now they're going to put pedal to the floor again, especially when the stock market breaks. And gold knows that, and therefore that's the blood flow in monetary metals, is the degradation of the money units. So if you're a gold watcher or along the gold market, watch the stock market, because if it breaks, it's going to cause the central banks to go berserk again. And gold knows that.
Okay. Yeah, that's interesting to hear. So you don't think the Fed have come in and sort of saved the day with their interest rate cut?
Yeah. Well, you go back to all the bull market peaks, and once you roll over, like 2000 dot-com top or the 2007 real estate top, once you start to roll over, what markets were a good place to be? Gold and T-bonds. Now, this time around, T-bonds, and I have to explain this when we do our analysis, some of the more intermediate type factors, well, even quarterly momentum, which is sometimes a long-term factor, but look like they're moving up. They look positive, even with the recent drop we've had in T-bond prices the last couple of weeks. And I think what's going on is there's some asset managers who are doubtful of the stock market and are beginning to shift assets into that orthodox alternative category. It didn't work in 2022. If you bought T-bonds to protect yourself from stocks, you got smashed, even worse in the T-bond market. This time it looks technically different. It does look like T-bonds will in fact provide several months of upside protection if the stock market rolls over. And I think if the stock market rolls over, watch the T-bonds. I think they're about ready to flip back up anyway after their recent several-week drop, in which case they will benefit just like they did in 2000 to 2002, 2007 through about 2009. T-bonds went up with gold. Yields went down, price went up. This time around, I don't think T-bonds will last that long. I think they may go up for a quarter or two. That's about it. I don't think it's a multi-year advance, because the very long-term momentum, the trend structures of T-bonds, was broken so badly in the past couple of years that any rally now should be treated as a counter-trend rally, not to be trusted as some long-term event. But gold's a different situation, and especially we like silver. And we think silver is at the edge right now of finally clicking into gear, technically speaking, and beating gold handily. And I think that's something you need to focus on.
And why do you think silver will do that? Is just because it's sort of
technical behavior historically. You know, you go back 50 years and look at silver price versus gold. And 21 of those 50 years, silver price each year reached at least 2% of the price of gold. Okay, right now it's 1.18% of the price of gold. Okay. And 21 out of 50, meaning it's almost normal to go to 2%. And in the big bulls of 1980, for example, the peak then, silver went to 6.5% price of gold. At the 2011 peak, silver was over 3% of the price of gold. And when we look at the technicals of that spread relationship between silver and gold, we measure it daily, weekly, and so forth, it looks ripe for an upside breakout. And it's evident even on the spread chart, but especially the momentum of the spread says, no, I've been lazy for the last year and a half or so. You know, silver made a low and gold made a low in price back in late 2022. We had that sharp drop. And then when they came up out of the hole, silver rebounded in relation to gold on a percentage basis. And since then, though, it's gone into this range of spread action at a very low long-term levels. It looks like it's ready to break out of that spread relationship and go into a strong outperformance relationship. And when that occurred back in the late 70s and into the 2010 period, 2011, when that spread engaged, silver also engaged. And gold went up strongly too at that point. So it was positive for the net trend of the metals, but especially it was positive putting silver in the outperformance mode versus gold. And I think we're on the cusp of that right now.
Okay, yeah, lots to talk about. So maybe if we go back to the Fed, and it sounds like you think that with this bond, I guess, extended bond bear market, is that because of high inflation? Is there other trends that you think will drive this, or is this more just the momentum that you're seeing?
It could be the degradation of the bond market in itself, in that, the debt to GDP ratio is ridiculous, the government debt. And this is true elsewhere as well. And I think that we're about to move away from fiat currencies. I think this crisis that's coming is bigger than anything we've seen in many decades. In fact, one good long human lifetime, I think this is going to be worse than any other event we've had. And I think it's going to be focused at some point in a snapping point type event, not an incremental one, where suddenly the world perceives the fiat currencies, not just the dollar, but the euro, the yen, et cetera, as merely paper that constantly decays in its real buying power. If you look at the M2 money supply of the dollar, go back to the 1950s, every decade, basically, the money supply goes up 90+%, almost doubles. And the last 10 years, it's gone up more than that. So monetary, that means, the number of paper units in your wallet buys less and less. So you have to take more dollars to buy a loaf of bread. Like when I was a kid, a loaf of bread was 20 cents. Okay. Do we have a wheat drought? No, of course not. You have a degradation of the money unit over time. And this is true with all the major unbacked currencies. And I think this crisis that we're about to face will expose that, especially our debt ratio, such that the bond market will be in total jeopardy. Not a comfortable place to be ultimately. I don't know what's going to happen to it, because it's not just going to be a dollar degradation versus other currencies. It's going to be all of the fiat currencies will suffer and be perceived as non-money. Now that's already happening in some countries in the world. China's, behaving in that manner, which is kind of unusual to think, quote, a communist country is effectively endorsing gold as the backing of a currency. Something's wrong there. They're right in their perception. And I think it's going to come back to the U.S. at some point. And I think the bond market crisis may help facilitate that. But for the moment, the T-bonds are, quote, a safe place to be. And I think that's one of the reasons why we're going to get another upside in T-bond prices, is because of asset managers, if they get spooked a bit by the stock market, like if we start to break the triggers I talked about in the S&P and the NASDAQ 100 especially, that money flow is going to occur. And also it's going to move more into the gold miners as well. We already know that there's some major asset managers that in the last 6 months have moved out of some tech stocks and into major gold miners. And I think that will be another place that money will flow once the stock market gets rattled.
Yeah, it's really interesting. But I guess I think of, there's been quite a few times over the past 6, 12, couple of years where we see these flash crashes where I guess there's a 10, 15% drop quite quickly,
Yeah.
and then get up very quickly. So is this something where you see things similar to that?
No,
or
I don't think it's the same this time. And the reason is, if you run long-term momentum of the U.S. stock market in particular, which is the most vulnerable of all the markets. Why? Because it's the biggest bubble. You look at the European markets, certainly not China. China's, not even double its price in 2009. We're 8-fold higher than we were in 2009 in the S&P, and about 17-fold higher than we were in 2009 for the NASDAQ 100. And the bull markets have been much older. You were talking 15 years now. Prior bull markets like 1923 to 29, or the bull market peaked in the 1970s in the S&P, like in the mid-70s, or the 2000 .com, 2007 peak. Those followed only after about 3 or 4 years of doubling or tripling in price. This one is far bigger. Now you can say, well, the economy must be better. No, look at an M2 chart and you'll understand, but especially look at Fed funds. I mean, there's never in history that we've had like 10 of the last 15 years where zero was the cost of money. So, if money's free, in effect, the pricing of money, the interest rate, people make decisions based on that. They commit money. They buy stocks. Companies expand their facilities. Governments spend more money, etc. Based on what? One of the bricks in their building structure is the cost of money. And if they've been deluded to think that the cost of money is free or going to stay so near free forever, then a lot of errors are committed over that period of years. And when they finally, the error is exposed, it's like ripping a bandage, taking a needle out of your arm that's been giving you hallucinogenic drugs for the last 15 years. And suddenly reality hits, regardless of what the Fed does. Like in 2000, 2002, they cut rates like crazy. 2007 to 2009 onward, they cut rates like crazy. It didn't help the stock market. And so when the bubble breaks, and when I look at the S&P and NASDAQ, we're looking at quarterly momentum breakage that's a handful of percent below where you are right now. But there's some initial breakage that occurs 1% or 2% below where you are right now. And once you break quarterly momentum, which is where we measure price in relation to its 3-quarter moving average, it's almost like a 200-day. There's a structure there that when you break it says, oh, this is like 87 or 29. They both have the same structure on quarterly. But the problem now is when you run annual momentum of the S&P or the NASDAQ 100, especially the NASDAQ 100. No, I will take that back. S&P and NASDAQ equally. If you get quarterly momentum breakage and it commences in this quarter, that'll drive price down. You can't drive it down because when you open next year, the numbers it takes to blow the floor out of annual momentum will be in your face. So a 10 or 15% drop now will be different than any one we've seen in the last several years because this one's going to blow annual momentum structure, which is the big dog. You break it and you're down for a couple of years. And I think that's the domino effect that's about to occur.
Okay. And you're saying that these trends have just kept creeping higher and higher because of the markets just kept going up and up,
Yeah,
basically.
there's still that belief structure. The Fed's cutting rates. Oh boy, that's good. Well, first off, it's not good. If you go back and circle in 2001, January, in the end of January of 2001, just barely off the 2000 high, Fed started cutting rates. Go back and look at the price chart. Do you want to buy there? No, the market flushed within months. Go back to 2007. 3 or 4 weeks before the top tick, the Fed had a surprise rate cut of 0.5%. It shocked the market, in fact. So the market S&P went up sharply for about 4 weeks and made its ultimate top tick in October of 2007 after a mid-September rate cut. Just like this time, mid-September rate cut, we've been going up since, okay? Same story. It didn't work then. Stock market peaked in October 2007 and went to hell for the next couple of years. And so the rally we're getting right now, in part due to, oh boy, the Fed's going to be accommodative, they're not being accommodative for good reasons. And investors need to realize that.
Yeah, I know a lot of people that I've been listening to have talked about sort of the credit spreads, and if they compare it to 2007, 2008, there's actually you don't see, I guess, that crisis mode in credit currently as you saw it in that period. So I'm not sure if that's something that you're paying attention
That's not
to.
something I look at, frankly.
No,
I
okay.
don't. I look at markets, especially via their momentum trend structures, and they usually momentum. It's like you say, usually I should almost always. Momentum will break its trend before price tells you it's broken its trend. So you always get an early warning from momentum factors. And right now they look like, again, if you sneeze, you're going to blow this stuff. And so this creeping, crawling every day up in the S&P where you make a headline on Fox News and CNBC, a new high close in the S&P. Well, the NASDAQ's not, but it doesn't matter because it's each day it's incremental. It's not really much above the July high. So somebody's selling up here. And I think when this particular rally ends, and it looks ripe to end when we look at short-term factors, if it ends and you roll over much at all, like 1% or 2%, you're going to start blowing these layers of structure that I talked about. in which case it'll get out of hand. So it's very important to watch the near-term action now, which we don't always do, because the near-term action could domino into the bigger stuff very easily. And I think it'll be different this time, on the downside, not just another correction.
Yeah, okay. And if we go to China, I know they've had a massive boom recently because of the talk about fiscal. Is that sort of a market that you're currently paying attention to, or you've been watching?
Well, I watched the Chinese market, and it frankly broke out over some things. It had been running ebb and flow with the U.S. stock market for past couple of years, where if we go up, they go up. Okay, not as much. Okay, they were more in a range, but the ebbs and flows tended to be coincident. But the last 6 months or so, not been. S&P's continued up. Shanghai broke through stuff, dropped another, went from 3,000 down to 26 something, but then it's flipped back up over 3,000 now, and it looks like it's sort of put its elbow over the curbstone. And yes, it was caused by overt intervention by the central bank and so forth in China. So that they infused drug into the market. And that may help stabilize it. It doesn't look like it's really going to go anywhere on the upside. It just looks like, one, it is not a bubble. So if you want to be bearish on China, you can be bearish if you want. But we're the bubble to be concerned about. Like I said, we're 17-fold off the low on the NASDAQ 100 of 2009 low. So our printing the money over that many years created this monster. China quit doing that for a while. Then they came back and infused more in this a week or so ago. And that provided, because the market was somewhat oversold, so it goosed. But it doesn't look as vulnerable as the U.S. market at all on a percentage basis. It's not a bubble, period. We're the most vulnerable market out there. Now, I'll include also the Sensex in India and also the Nikkei. They look very vulnerable. They've been stronger than the U.S. market, and they look vulnerable for a crash type event on the downside. China does not.
Hey everyone, sorry for interrupting. I just wanted to extend a massive thank you to you for listening and tuning in and for your support over these 3 years. So we've had, hundreds of guests that we've welcomed on the podcast. We've had millions of views with hundreds of thousands of different people listening in. So I just wanted to thank you. I started this as a student. I'm now currently working and I've always done this on the side just because I have a passion for it and I've enjoyed it. And probably similar to yourself, you listen to all these, different YouTube channels and podcasts of people listening to different guests. That's how I started, and I just wanted to sort of take the plunge and be able to have the opportunity to speak to these people, and you've made that happen. So thank you very much. Just myself, don't make any money from this, and it's really a passion project. So thanks for supporting that passion of mine. If you wanted to support the channel, all I ask is if you could like, subscribe, or even comment, positive or negative feedback. I'm always willing to take constructive criticism. I'd really appreciate that. But otherwise, thanks so much. If you can believe it, only 14% of our listeners actually subscribe to the podcast. So if you can, great. If not, no problem at all. Thanks for listening, and let's get back to the show. Okay, that's actually quite interesting to hear that. As you said, the US is just so overvalued. It's had all these things going, and how do you see? Do you have any thoughts on the debt and what would happen if we saw this crash? Because I think
we're in a debt crisis. I mean, I think the government's in a crisis now. It used to be the debt problem in 2007 to 9 was what? Mortgages. Okay, private debt. Quote. So not this time. This time it's government debt, and now for the moment, again, T-bonds look like they'll behave okay. And they'll be a place to be for a little while. We don't trust them to sustain, but for a while they'll soak up some of the money that moves out of the stock market and no doubt benefit. But ultimately, and I think by ultimately, I mean by sometime next year, we'll see evidence of a renewed collapse there, and perhaps even worse than we've seen so far, meaning a situation where total doubt occurs as to the viability of the instruments and the entity that issues them. Okay. So, and this will also be partly a reflection of the doubt about fiat currencies, unbacked paper, that can be inflated at the will of a government. People will finally realize, for instance, inflation, everybody says they measure it by commodity prices, which is BS. Commodities are one asset class that can go up with monetary expansion. And they ebb and flow. Stock market's another asset category that can be inflated by monetary degradation. So they come and go. Now, the Fed doesn't care about stock market inflation. That's okay with them. Prices can go through the roof. But they care about commodities. But the problem now is commodities have cooled off. In fact, they peaked in 2022 after a doubling, what we call the move in October of 2020. Bloomberg Commodity Index then was 70. By early 2022, it was 140. It doubled. It was still cheap. If you go back historically and look at prices, that move to 140 was still well below the 2011 high and the 2008 high. So commodities weren't off the page, but they had a good move. Well, then the war started, Ukraine, Russia thing. And commodities peaked like 1 month later and spent a sharp drop into late 2022, early 2023. So the Fed says we're fighting inflation. Actually, the commodity bust had already occurred, the correction, which went halfway back to the 2020 low, by the way, in price. You had a 50% correction. And then you went to sleep on the Bloomberg since all during 2023 and into this year. So basically a sideways nothing after a 50% pullback. And so naturally, the Fed's going to want to say, well, look, we tamed inflation. No, they didn't. Commodities had a break, and ultimately your numbers finally followed the Bloomberg down. Ultimately, the commodity-related factors in their inflation data were pulled down by the Bloomberg dropping, which dropped way before they ever cut rates. Started raising rates again. So it was the market that brought that inflation down. But right now, it looks like the Bloomberg, in the next infusion of liquidity by the central banks, commodity asset category looks very good for a sympathetic upside with gold, which it's not always the case. You go back through the years and you'll see that quite often commodities don't trend with gold. Gold's on its own. It's a monetary metal. It's not a commodity, okay? And gold, for example, between, let's say, 2015 bear low, just above 1,000, by mid-2020, it had doubled, over 2,000. During the same 5 years, Bloomberg Commodity Index was under pressure the entire time. In fact, didn't make its low until 2020, when gold was making its peak. And when gold went into this trading range, after its mid-2020 high above 2,000, what did the Bloomberg do? It shot up, doubled, while gold went sideways. So it isn't linked. But right now, it does look like it's going to join gold and follow. In which case, the Fed's dream assumption that they have cured inflation, they don't control JS, okay? That Bloomberg turns up, and they're going to get the bad inflation data again. But the problem is they're going to have this other problem with their other mandate, because the economy will be weakening and the job market will be weakening, in which case they have to ignore the rising commodity prices again. So, the guy at the other end of this, the average guy on the street, is going to get hurt again. Monetary degradation ultimately shifts from asset to asset. And now I think the commodity category is about to benefit from the ongoing monetary degradation.
Okay. And so you see this being another, commodity super cycle? Do you see it? It being similar to what we saw in 2020 and after that, just for a sort of few years period? Or do you see this being longer?
I think you're going to have a good move out of commodities, and they'll be perceived by asset managers, particularly commodity-related stocks like base metal miners, agricultural-related companies. They don't look like the stock market at all. If you put them up on even a price chart, put some of these base metal mining companies or the ag ETF called MOO, which owns a lot of agricultural-related companies. They don't move with the stock market. They're in their own world, and they look like they're ripe. They're turning. In fact, they not just look ripe; they are turning. And the Bloomberg is in process of turning back up as well. And it's not just a few things in the Bloomberg Commodity Index; it's quite a few of the major markets. The grain markets look like they're turning. Copper is turned. It's behaving better than the Bloomberg even. Crude oil and natural gas have bottomed, and they're ready to go up. Now, they led that last move in the 2020 surge to 2022, oil and natural gas. But this time they'll join, but I don't think they'll be the leaders. I think food is going to be the most painful part. Not coffee and cocoa. They've already gone berserk. They're a different animal. But the broad commodity complex looks ripe to join gold now. And when did this happen the last time? 1978, 79 to 1980, when commodities exploded while the stock market was a wasteland, and they followed gold up.
Okay. Interesting to hear. So, where do you think gold and I guess these commodities are going to go? Do you have sort of, a price target?
Where do I think gold's going to go? That's a difficult question. There's some fundamentalists I know in the gold market who have assessed, we could go to $20,000 or more, and I don't deny the possibility. That sounds ludicrous, okay? It's merely a reflection of the degradation of the money unit. It's not a reflection of gold going up. It's a reflection of the reality that the money units are collapsing in value. Okay, that's been historically the case. If you look at the last two bull markets in gold, which weren't under situations of the type of crisis that we're about to face, monetarily speaking, around the world, especially the developed world, gold went up eightfold. 1976 had a correction low just above 100. By 1980, it was 850. Okay. You go back to the 2002 lows. In that period, gold was just above 250. It went to 1920 by 2011. Okay. So those were like, if you did it twice in the last 50 years, you could do it again. And all you'd be doing is reflective of those ratio scale moves. So gold got $8,000 from its 2015 low, which was $1,050. So that would just be merely replicating the ratio move of those two bull markets, which existed under conditions that aren't as dangerous economically and monetarily speaking as they are now. Now, if we're right about the bond market, and I think we are, failing in a miserable way over the next year, especially not over the next few months, sometime in 2025, when it starts to fail, and the perception is, especially about U.S. debt, because we're the one with the biggest bubble, remember. So when it starts to break, we're going to have a lot of economic pain. Government's going to want to spend. Of course, I don't know who's going to be president, but almost regardless, you can have that crisis. And it's not, frankly, not the fault of whoever becomes the next president, because it was a crisis building for decades. And that will unleash gold in a way that could vastly beat the eightfold moves. Now, when we look at silver, and we looked at that ratio I talked about, where let's say 2% of the price of gold, which occurred in 21 of the past 50 years, okay? If silver went to 2% of the price of gold, and gold went to 8,000, well, what's that, $160 an ounce, okay? And if gold went beyond that, or what if silver went to 3% the price of gold, which it did in the 2011 bull? Just a couple $100 an ounce. So the projecting where they might go right now is difficult. I can technically see certain levels above that might be pause stops on the way, but not tops. Like we think right now that gold, the next surge could carry up close to 3,200. Well, if silver happened to match that, but went up to 2% of the price of gold at that time, silver would be in the 60s. And we think this next surge in silver, get through the recent congestive action up at 32 to 33 area. You get up through that stuff. In fact, we got some trigger numbers just below 32 right now that say you're going through it. You get through that, I think we're going to blast out the dual highs of $50 that occurred, decades ago, and also in 2011. I think those dual highs will come out with a whoosh. And somewhere on the other side of that, finally, silver will be temporarily exhausted after blowing the stops, so to speak. But ultimately, I don't think this surge we're about to see is any top. I think it's just the next stage. These bigger events happening, the unfolding of the stock market bear, which creates panic on the part of central banks, et cetera, that's going to further fuel the monetary metals.
And then I'd imagine go into the miners, because they've sort of been extremely unloved over the past few years, and many people link that to international central banks buying precious metals, but Western investors selling precious metals and the miners. So I think that's what a lot of people are talking about.
That'll be a gush, when they suddenly say, "Oh my God, I missed it," But already some major asset managers, and Stanley Druckenmiller back in February, for example. I cite him all the time because he was probably the first. He dumped a bunch of very big name tech stocks and bought Newmont. Well, I mean, how well did he do? Well, it's trading right now, Newmont, at about $54. Okay. It's been there for 3 months. It's a level that when you go through, it's going to gush again. It was at 31 back in mid-February. So he's done pretty good on Newmont, and yet it hasn't made headlines. But that's a heck of a percent move. And it's only getting started by our technical metrics. It's the big blue, largest gold miner in the world. So naturally, large asset managers, they don't tend to go for the juniors and stuff like that. It's the risk assets. They go to the blue chips. But I think once you get the public interested, and American public especially just is bored to hell about gold, silver, mine. They're not in tune yet. But once they get in tune, and maybe silver gushing through 50 will wake some of them up, they'll go start that. You'll watch those junior miners, they'll start to go ape on the upside, percent-wise, and get gobbled up by the major miners. But they're laggards right now. I think you've got to focus mainly on the medium to large gold and silver miners. And with an emphasis somewhat on the silver miners, they're doing better on a percent basis right now over the last several months, especially than the gold miners. But once you build a little bit of fever, especially in the western part of the world, into perception that gold's good, a good place to be, and you'll start seeing the junior miners go up a lot more percent-wise. I don't know how much more, but a lot more. And when you look at the overall category of gold miners, like the XAU index versus the S&P, or XAU index versus gold, and go back decades and look at where it is right now in terms of valuation, it's dead quiet. It's basing. It's not going down. In fact, it's the spread relationship between XAU, the gold miners, Philadelphia Gold and Silver Miners Index, is well off its 2015 low. In fact, it's more off of its bear low than gold is. So it's actually gained more than gold over the last since 2015 low. People don't recognize that. But if you look at the spread, you'll see it actually did. But it's still kind of boring, and it's still very, very cheap historically. And it's got technical dynamics that we can see on that spread relationship between the miners in gold and the miners and the U.S. stock market that says when you turn up, you could gush. The spread, in other words, once the spread breaks out, treat it like a price chart. Its next resistance is so high that you could see a massive percent gain in the miners relative to the S&P and versus gold. So it's definitely a preferable place to be rather than gold itself.
Yes. Let's see. I think a lot of people have been talking about this for a while, so let's see if it comes through. But yeah, Michael, thanks so much for your time today. Really appreciate it.
Thank you.
Last question is, what is one message you'd like people to take away from our conversation?
Well, watch the stock market, even if you're not in it. Hopefully you're not in it alongside, but especially the U.S. market, because when it snaps, some of these other biggies will go too. The Sensex and the Nikkei look like technically like they could join in. And they're bubbles as well. Now, the European market's not quite a bubble. It's gone up a lot since 2009, but it's nothing like the U.S. market. So you could get an economic downturn there, but not have the same percent consequence to their stock market. We're the real vulnerable one. And when we go, it's going to exacerbate all kinds of other underlying crises that have been building and building for decades, specifically U.S. government debt. And I think when that comes to a head, panic occurs that will drive real money up.
Thanks again for your time. If anyone wanted to find out more about your work and what you do, where would the best places for that be?
Oliver MSA for Momentum Structural Analysis, olivermsa.com. Go to the site, spend some time. We talk about our methodology, why it's different, how we do it, and so forth. There's a lot of archived reports there, historical reports we've called the stock market tops and bottoms over the decades. Been around since 1992. We started mainly with institutional clients up through the first 15 years of our existence, only institutional. Some large hedge funds, one Vanguard fund at the time, and so forth. And anyway, then we opened to private subscribers in 2016, and they get a different kind of input than they would get from other technical reports. We look at price, but it's secondary to our momentum work, and I think that's an edge that we offer.
Perfect. I'll put that in the description below, but thanks again for your time.
Thank you, Anthony.
Hey everyone, thank you for listening. I really appreciate the support. If you've got value out of this, I'd really appreciate it if you could like, subscribe, or comment. Good or bad feedback. I'm always open to that. But it really helps with the channel. As I said before, only about 14% of people actually subscribe to this channel. So if you were to that, it would really help. It could mean we could continue to grow. If not, thanks for watching and see you on the next show. And you also might like this video right here. All right, thanks again.